Okay, let's dive right into this explainer. Today, we're decoding IAS 8 and exploring a really crucial fork in the road of financial reporting, knowing when to move forward and when to rewrite history. Now, if you've ever stared down a set of financial statements, it's easy to think those numbers are curved in stone. But the reality, business is messy. It's inherently uncertain, and it's constantly evolving. So our main focus today is unpacking the exact difference between changing an accounting estimate, which is all about adapting to new information, and correcting a prior period error, which is all about fixing a past mistake.
Here's our roadmap for today. First, we'll look at the imperfect financial statement. Second, changing accounting estimates. Third, correcting prior period errors. Fourth, we'll compare forward versus backward application. And finally, what to do when fixing the past is just totally impracticable. Let's get to it.
Section 1. The imperfect financial statement. Why numbers change.
We need to start with a foundational truth about accounting. Financial statements are not perfect crystal balls. As paragraph 33 of IAS 8 makes incredibly clear, using reasonable estimates is an essential part of preparing financial statements, and doing so absolutely does not undermine the reliability. It just means you're realistically reflecting the dynamic, unpredictable nature of commerce. You have to make judgments based on the latest available information.
Moving on to Section 2. Changing accounting estimates, adapting to new information. Because we are constantly gaining new insights, accounting needs a practical mechanism to process that when our perspective shifts. Think of an accounting estimate as a forward-looking pragmatist. It adapts to new circumstances or new experience. And, this is the absolute key here, it is strictly not a correction of an error. By its very nature, a change in an estimate is just an adjustment that comes from a fresh assessment of an asset or a liability's present status. When new information comes to light, you adjust. You aren't admitting you were wrong in the past, you're simply acknowledging that you know more today than you did yesterday. To really ground this in reality, let's look at some common examples. Take the useful life of a factory machine. You might initially estimate it's going to last 10 years. But say after 5 years, due to some amazing maintenance or maybe just sheer luck, you realize it's actually going to last 15. You didn't make a mistake in year 1. You just gathered more real-world experience by year 5. That exact same living, breathing logic applies to things like estimating bad debts, warranty obligations, or dealing with inventory obsolescence. You adapt as the facts evolve.
Which brings us to Section 3, correcting prior period errors, the ghost of the past. Now we've got to shift our focus away from the future and look all the way back to the past. The crucial question is this: what happens when a number is wrong? Not because of some new development, but because we completely miss something that was already sitting right in front of us. Well, unlike those forward-looking estimates, an error is truly the ghost of the past. This bucket includes your mathematical mistakes, oversights, misinterpretations, and yes, even fraud. If you simply miscalculated a depreciation formula in a spreadsheet, or if you completely misunderstood a contract that you were literally holding in your hands at the time, that is an error. You aren't reacting to new information. You are misusing old information. IAS 8 actually draws a really hard line here. To be classified as an error, the standard literally states there must be a failure to use or misuse of reliable information. That means the information had to exist, and you had to be able to reasonably obtain it before those financial statements were authorized for issue. If both of those boxes were checked and you still got it wrong, you, my friend, have an error on your hand. All right, Section 4. Forward versus backward, the fork in the road. This right here is the absolute heart of IAS 8, and it's what dictates two entirely different accounting treatments. Estimates live in the present and the future, while errors demand that we go backward in time to fix what was broken. So if it's an estimate driven by new information, we apply it prospectively. But if it's an error driven by misused old information, we apply that retrospectively.
Let's break down the actual mechanics of this financial time travel. Prospective application basically draws a line in the sand. It means you adjust your profit or loss from today onward, in the period of the change and any future periods it affects. Retrospective restatement, on the other hand, means you actually go backward into your comparative financial statements for prior periods, and you correct those numbers as if the mistake had never, ever happened. You are literally rewriting history to restore comparability. But wait, there is a massive catch here. You absolutely cannot use hindsight to calculate a past error. Let's say you're correcting a liability for employees' accumulated sick leave for last year. You can't use the fact that a massive, totally unexpected flu outbreak happened this year to adjust last year's numbers.
Why? Because that information simply wasn't available to management back then. Any correction has to strictly reflect the circumstances that existed exactly when the original event occurred. No hindsight allowed.
Let's move to Section 5, when fixing is impracticable, the limits of time travel.
So what actually happens when we hit a wall while trying to rewrite history? What if it's just simply impossible? Maybe data gets lost, or maybe it requires assumptions about past management intent that we just can't prove today. Sometimes, figuring out what a number should have been 3 years ago requires a huge estimate of its own, making it completely impossible to untangle what you knew then from what you know right now.
Thankfully, IAS 8 acknowledges this reality with the concept of impracticality. But let's be really clear here. Impractical is not just a free pass because the math is annoying or tedious. You are required to make every reasonable effort. But if the effects truly cannot be isolated without using that forbidden hindsight we talked about, the standard does give you a legitimate way out.
Here's the fallback plan. You go back as far as you practically can. If you can only accurately recreate the data starting from last year, then you restate the opening balances for last year. But what if you can't even do that? What if the cumulative past effect is just a total mystery? Well, then, you correct the error prospectively from the earliest date you possibly can. Basically, you do your absolute best to salvage comparability without fabricating history. I hope this explainer has helped clear up the fascinating fork in the road between estimates and errors. Recognizing new information is a really healthy sign of a business moving forward, but ignoring old information is an error that yanks you right back into the past. So the next time you're sitting in a boardroom and someone casually suggests tweaking a past number, ask yourself a provocative question. Are you genuinely adapting to a changing future, or are you just trying to bury a ghost from the past?